Right. We will look at the definition of budget first of all in our session, budgeting. Uh, a budgeting is a quantitative expression of a proposed plan of action by the management of an organization for a specified future period. So you may prepare a budget for a 1 year, 6 month, monthly, whatever the period, there is a period. It's a kind of proposed plan of action. So you are converting your strategic direction, you are converting your strategic planning, activities into a quantitative expression. And also it is the management of organization. So thereby it is formal, not informal. It is formal. So thereby budget is a kind of document which is prepared by the organization just to operationalize to operationalize their strategic plan or their strategic direction. So thereby budget is always linked with the strategic planning or strategic direction or policies of the organization. Even if you take the government budget is really, we know that government is producing or introducing annual budget to the parliament for parliament approval. It's the results of the economic policies. It's the results of direction of the country. So thereby budget is always, you get quantitative expressions, maybe in rupees, maybe in units, budget. So I hope that you understand the meaning of budget. Discuss the importance of short-run and long-run budgets in the strategic implementation process. So you may talk about long-run budget. Even you can prepare the budget for 3 years, or you can prepare a budget for 1 year, 6 months, 3 months, etc. But whatever the budget you prepare, that has to be linked, that has to be, combined with the strategic direction or strategic objectives or strategies. Suppose you are going to increase your market share by 10%. If you are going to increase your market share by 10% as a organizational objective direction, so you see that existing sales has to be increased. So when the sales increase, production will have an impact. When the production really increase, you need to collect raw material. You need to have additional labors. You need to have additional factory space. You need to have additional skilled labor, unskilled labor, overheads. So you may, if you are not only producing, you are selling. If you manufacture and distribute, then you need to incur new marketing expenses, distribution cost, additional overheads, maybe additional tax. So thereby, budget is the important short-run and long-run budget in the strategy implementation process, because your operation and the activities of an organization depend on the strategy implementation or strategic planning or the corporate plan. So what we are trying to do is we are trying to convert this strategic planning or the corporate plan or the strategic direction into operational matters by putting quantities into the respective items. So if you look at this relationship between the budget, strategy, you see strategy is there, long-run planning. You may have a long-run planning, strategic planning. You may have the short-run planning. So strategies, maybe your strategy is cost leadership. Maybe your strategy is differentiation. Maybe you may adopt penetration strategy. You may adopt market development strategy. So strategies may vary from business to business depending on the organization size and product life cycle and objective of the organization, nature of the competition, etc. Anyway, you may have long-run planning, you may have short-run planning. So if you have the short-run long-run planning, you have the long-run budget. And if you have a short-run planning, you may have the short-run budget. So all these are interlinked. Strategy will influence the long-run planning. Long-run planning may influence the strategy. Interconnectedness is there. Okay. Then we will come to the purposes or the discuss the purposes of preparing or the objectives of preparing budget. Why we prepare budgets? So any answers if you like to put into the chat box? Why we prepare budget? What is the purpose of preparing budget? Or I would say function of the budget. What roles budget will play really? By preparing a budget, so what we can really, expect, what outcomes you expect from a budget document. Yeah, planning, controlling future operations. Good. It's a planning document. You can consider it as a planning document. You can consider it as a controlling document. Yes. Very good. Very good. You are trying to coordinate the activities within the department. So thereby it's a communication tool. It will help you to evaluate performance. I think very good. Yes. So thereby you understand the budget is really, serving, delivering different purposes. There is no X number of purposes. You can list any number of purposes. Thank you. So then you see purposes. So the planning annual operations, as you told, it's a planning document. Coordinating activities, it's a kind of, different activities, different department, different people, different segments, different branches. And also even budget will contribute to coordinate outside parties. Maybe you are coordinating with suppliers, you are coordinating with other utility providers, other service providers, maybe telecommunication industry, maybe IT providing, maybe security service outside the organization. So thereby coordinating the activities of various parts of the organization, ensuring the part of are in harmony with each other. Here the thing is, I think that part of the organization, not only the part of the organizations, even outside parties, we can coordinate by using the budgeting by looking at the data, targets, etc. It's a communicating, planning to the various responsibility of centers. It's a communicating tool. You can communicate the responsibilities of various responsibility centers. It may be a cost center, it may be a profit center, it may be an investment center, whatever the center, you communicate the responsibility. So thereby, budget will help you to accountable. Accountability concept is incorporated through the budgeting. Now you see the annual budget presented to the parliament. So parliament will have a debate. So there, of course, we are trying to ensure the accountability. You have to, adhere. Once it's approved, you have to adhere to the budget. responsibility center. So thereby it's kind of, communicating tools, communicating responsibility of different parties inside the organization. Motivating managers to try to achieve the organizational goals. So thereby, when the sales target is given, maybe units, maybe a particular product, maybe particular division, maybe particular area. Suppose our sales target for the southern province is 10,000 units of the particular item product, baby shampoo, 10,000. That is the monthly unit. Maybe your targets, for example, in insurance people, they take you targets, sales target based on their value, maybe the policy value, life insurance value, whatever the things. So thereby, once you receive the budget, once you prepare the budgets, each division, independent parties, or the people inside the organization, units inside the organization will motivate to adhere to achieve the budget targets. So thereby, in a sense, we use the budget to motivate. Then the controlling activities, of course, you may compare your budget data with the actuals. Suppose your monthly target was what sales target was 10,000 units. Say May 2002 May sales target was 10,000 units, and your actual sales was really 4,000. So thereby you see that 10,000 and 4,000, there is a big difference. It's adverse variance. So thereby you can take corrective actions. Controlling activities means you identify the gap, you identify the issue, you discuss it, and you take corrective actions. You just want to avoid that mistake, that particular bottleneck again, just so because it will be a barrier to have your strategic direction. Then the evaluating the performance managers, budgeting tool, budget would be evaluating the performance managers. So thereby it's a performance evaluating tool. So thereby you see that budget do have different functions. Basically, it's a planning and control tooling, as someone told, but within this planning and control, coordinating, communicating, motivating, all these functions, management functions are there. So thereby budget is a kind of, budget serves multiple purposes. And all these purposes, if you look at from economics perspective, so thereby budget can look at from the economic perspective, where you do a lot of planning, try to ensure coordinating different activities, communicating among different members to communicate, to ensure their responsibility to make aware what we are expecting from each unit, each person or division. Then the controlling activities and evaluating the performance. All these, what I want to communicate is that all these are economic reasons. But in addition to, when you take a budget, you may have a political view also, political perspective, to achieve the political, not only the economics objective, to achieve the political objectives. Maybe in a particular organization, CEO or the group, when you allocate resources among, among different branches, different divisions, different business organization. Suppose group of company. Under group of company, you may have different business units. We call it subsidiaries, or we call it businesses. So the group may have, the guy who is performing very closely, the guy who is working very closely, the CEO who is working very closely with the group will get more resources. So thereby, it's a kind of political document. If you look at the Sri Lanka government budgets, powerful ministers will get more resources. Powerless ministers will get less resources. Powerful ministers will get more money. Powerless people will get less money. So thereby, when political perspective, political view, political purpose really incorporated into the budget, economic purposes you need to sacrifice. You need to sacrifice the strategic direction. You can't achieve the objective of the organization. So thereby, that is the nature of the budget. So budget, you can consider it as a, political view. In addition to that, budget you will serve the budget you can look at from the resource allocating model. So budget through each and every organization, we have limited resources. When we have limited resources, we need to allocate. So budget is a kind of tool which is used to allocate resources. Now you see nowadays, petrol, the minister is talking now, allocating petrol among the needy people and try to identify priorities. අපි ඒකට කියනවා rationing, සලාක ක්‍රමය, rationing of petrol. So thereby, those who maybe work in hospitals will get priority. Those who work in emergency services will get priority. And they might, even divisional secretaries might identify needy people or the people who really need petrol to, do the essential services and issue some letters for them. So what I want to communicate to you is that that's a kind of rationing. That's a kind of allocating, like allocating resources among people. We use the rationing. අපි කියන එකට සලාක ක්‍රමය කියලා. ඒ වගේම තමයි budgeting also. You can consider budget as a resource allocating model, but it's much more formal. It's much more rational. A selected period for which a budget is prepared. The budget period means, budget, the period. So for which period we prepare the budget. You may prepare the budget. If you take the government budget, we prepare it for 1 year, 12 months. You may prepare the budget for 3 months. You may prepare the budget for 6 months. You may prepare the budget for 1 year. You may prepare the budget for 2 years, long run. So that is the budget period. So budget period is always, the period. Then we have another budget called rolling budget. But in a rolling budget, what we do is, suppose you are preparing a 1 year budget and you prepare the budget monthly wise, month 1, month 2, month 3, month 4, likewise 12 months, maybe January, February, March. When the January is over, you will add another month, maybe the January again next year. For example, suppose rolling budget, you need to understand the rolling budget. Suppose your budget is for basically, say, 12 months. Then you prepare the January budget to December, right? You may have the data, say sales, right? So you have different months, January, February, March, okay, now December. Now rolling budget, when you have a rolling budget, when the January period, January month is over, you will add the January next month. Suppose this is 2022. If this is the 22, now when the January of 22 is over, you will add the 2023 January. Now when this is, become actual, you will add another month. So what happened? Then the budget period remain constant. Budget period is 12 months. So thereby, when you adopt this method, the rolling budget method, always you are updating the budget. Always you are preparing the budget. But if you look at the government budget, we don't do the rolling budget. We prepare now. We have, 2020 budget. Once the 2020 is getting, closer to over, you prepare the other budgets. I think somewhere in June, you start preparing budget for the 2023. So that is traditional budgeting. But rolling budget is always you add one period when that particular period completed or become actuals. So what happened is always you have 12-year budget if that is the case. I think you got the meaning of rolling budget. You got it. Then the rolling budget, as known as a continuous budget, continuous means always 12 months is there. Changes constantly throughout the year. Throughout the year changing, that is true. This ensures that 12-month budget is always available, adding a quarter in the future as the quarter just ended is dropped. Suppose you prepare the budget quarterly, quarter one, quarter two, quarter three, quarter four, then the one particular quarter is over, you add up another quarter. Rolling budget also ensure that planning is not something that takes place once a year when the budget being formulated. Instead, budgeting is a continuous process, and managers are encouraged to constantly look ahead and review future plans. So, one way rolling budget ensures the full budget period. Secondly, it's communicate that budgeting is not a one-off transaction. It's a continuous process. Another advantage is like that actual performance will be compared with more realistic targets because you are always reviewing the budget. And main disadvantage is that it creates uncertainty for managers because the budget is constantly being changed, the rolling budget. Is it clear? Okay. Administration of the budgeting process. The purpose of administration is to get the approval for the budget to get the support, the process of administration. So you may appoint budget committees consisting high-level executives to ensure the realistic budget and coordinations. Budget committee will appoint a budget officer, basically the chief. If you take private sector organization, CFO would be the budget officer, or maybe appointing another expert accounting guy from the accounting department. Anyway, the budget officer would be a accounting professional. The role of the budget officer is coordinate the functional budgets into master budget. So the budget officer will talk to the salespeople, then they will prepare the sales budget. Then budget officer will coordinate with the production department. They will prepare their production department. Budget officer will coordinate with purchasing department. They will prepare the purchasing plan or the purchasing budget. Likewise, each and every component of or division of an organization will contribute to prepare the budget under the guidance, under the supervision or under the monitoring of budget officer. So thereby budget officer is important. Normally budget officer would be CFO, chief financial officer, or chief accountant, depending on the top position you have for the accounting and finance background. Budgeting process, of course, it's a lengthy process. You have 9 items are there in the budget process. Communicate detail of budgetary policy. and guidelines to those people responsible for the preparation of budgets. Guidelines, budgeting policy mean that the deadlines, forecasting methods, formats, our policy, when to out, what factors to be considered, how to tackle the uncertainty. So all those guidelines are coming. Determine the factors that restrict the output. Which factor restrict your output? Which factor restrict the output? Now, if you take the country, nowadays, our country output is now restricted by mainly by dollar supply, foreign currency, plus the local money supply. So thereby, as a country, I'm talking, just because of this scarcity of foreign reserve, scarcity of dollars, scarcity of, lack of government income. Government income is very low. That's why they are going for money printing. So that would be a restricting factor. But for an organization, yeah, constraint. Yeah, correct. Limiting factor is the constraint. But when you look at the constraint, we call it really, we call it, yes, it's a good question. Here we call it a limiting factor technically. Limiting factor. Technically, we call it limiting factor. Limiting factor is, you can say it's a constraint. But when you use the constraint, you may have other constraint as well as. We are talking about principal limiting factor. Principal limiting factor. Principal limiting factor. So thereby, here you can say constraint, but I agree. Even I agree that is true. But it's in certain cases, limitation, constraint may not the technically use word in accounting. We call it limiting factor or principal limiting factor. That means that is the factor, that is the variable, only one variable. That is the main variable which limits our operation, our output. Now, for example, suppose you have you are going to, okay, per day rice demand is 60 lakhs. Per day demand is 60 lakhs, right? If the demand is 60 lakhs in the country for rice, you can calculate the monthly demand, etc., etc. But you see that giving more than 60 lakhs to the market, or when you produce it more than 60, useless. So thereby your factory should focus on 60 lakhs production. For example, suppose you are running a bakery. According to the data, your experience, past experience, and your father's knowledge and your family knowledge and bakery knowledge, you see that in your area, you can sell only 1,000 bread per day. If you know that your demand is 1,000 bread, I know that your bakery, you will produce maximum 10,000 bread or 1,000 bread demand. So thereby that demand, if you produce, you can produce more than that, but you can't sell it. So thereby you see that always demand is the principal limiting factor. Demand is the principal limiting factor. So thereby, you may produce each day 10,000 breads and distribute. So when you produce 10,000 breads, you may have stocks accordingly. You may have labors accordingly. You may have energy accordingly. You may have your distribution vans or the distribution method accordingly. You may have your, distributors accordingly. You are not expanding your distributors because you know that to distribute this 10,000 breads, existing channel is important. So I think you got the point. So thereby, based on this limiting factor, your whole operation will depend. All the other activities, including the production, including the sales, marketing, HR, all these matters, service supply, quality improvement, all these depends on the limiting factor. Generally, the principal limiting factor is demand. But in certain cases, you know that even though you have 10,000 of breads per day, you can't produce 10,000 because the plant is not available. Or particular ingredient is not available for 10,000. Government is only issuing, raw material only for 8,000 breads. So thereby, in that case, even though principal limiting factor is demand, in this scenario, in this context, limiting factor is raw material. You got my point? So thereby, it depends. Your limiting factor depends on the context, but generally it is demand. In certain cases, labor. If you can't find out labor, you may really, limit your output. Right, okay. Preparation of the other function. So thereby, basically the factors that limit output may be whatever the resources in addition to demand. Preparation of sales budget. Then, so of course, what is important is first you have to prepare the sales budget. Once you prepare the sales budget, why we are preparing sales budget will reflect the demand. We believe that principal limiting factor is the demand. That's why we prepare the sales budget first. We may talk to people. We may look at the different marketing scenarios. We will look at the customer, attitudes, perceptions. We may look at the cultural events. We may look at the religious event. We may look at the culture value of the customers, pattern, trends, etc. when predict the sales budget. You know that if you are in April month, if you are in the garment industry, the New Year season is much more important. Not only New Year is important for garment factory, for other daily needs suppliers, maybe chicken, maybe rice, maybe, some other biscuits manufacturers, maybe whatever the things you see that during the New Year, April, so many items you get high demand. So thereby in that era, your sales forecast, that period, your sales forecast may be a little bit high. So thereby you need to consider seasonal, cyclical variations when making sales budget. Then based on the sales budget, you may prepare the functional budget. So you prepare the functional budget. Preparation of master budget, negotiation budget with superiors, coordination review budgets, financial acceptance of budgets, ongoing review of budgets. So those are the what do you call budgeting processes, what you have really focus. So thereby you start from the sales budgets, then you finally prepare the master budgets, then you negotiate with your supervisor, you present it to different parties, you have a discussion, then coordination and review budgets, then acceptance, ongoing review of budget. Once the budget is into practice implementation, each month, each quarter, you need to monitor. So there are different monitoring mechanisms, maybe audit committee, maybe budget committee, maybe monthly progress reports, monthly meeting, divisional meetings can be considered as ongoing review of budgets. If you look at the government budget, also same thing. So you may present the budget to the parliament, not only one, second time reading, third time reading, then you argue on different line items. Then finally, parliament members really approve or reject the budget, then implement. So basically, those are the budget areas. Then you see that relationship among budgets, you may focus on various factors, internal and external factors when sales forecast. Sales forecast is much more important. So you may think about your strategic direction, your strategies, company objectives, policies, current year figures, last year figures, new trends, future trends, what will happen after this year, what are any trends, any growth in this industry, any growth in this business. So those matters you will look at. Business conditions and outlook for the industry. So are there any special events taken place in this industry? Is there any new market for us? Is there any new rules from the government? So likewise, if the government is limiting the import of raw material, then of course you know that it's uncontrollable variable. We can't sell the same amount last year what we did, because import is a constraint, as someone told. And if the labor market is not, if say labor market is uncertain, then it's problem. If the political situation in the country is uncertain, very difficult to get the sales. But in certain cases, even the labor market, even the political uncertainties there, you can have a high level of sales, no problem. If you can convert it as an opportunity, then of course you may have the sales figures high. But anyway, what we are trying to tell you is that you need to consider the business environmental factors, and also internal organizational matters when forecasting the sales fee. If the limiting factor is on the production side, these are adverse. These are adverse. Okay. Suppose, meaning that you don't have enough raw material, then you can't go for the maximum demand. Then you have to limit the sales according to your production. So thereby, basically, you start from the sales budget, then go to the production. But in certain cases, if the limiting factors are relating to direct material, raw material, some other facilities in your factory, then of course you prepare the production budget and go to the maybe sales. Okay, anyway, sales budget, production budgets, administration budget, research and development budget, capital expenditure budget. Capital expenditure means not the current day-to-day. It may be spending on new machineries, new technology, new software. Capital expenditure, the meaning of capital expenditure. The benefit is not limited to one financial year. benefit is spread over many years. That's capital expenditure. Just capital expenditure not to maintain your capacity, but to expand your capacity, you incur the capital expenditure. Then sales budget, of course, you may have the sales and distribution budget, material budget, labor budget, expense budget. Then stock budgets, debtors budget, creditors budget. You may have different kind of budgets. Ultimately, all these budgets will have an impact on cash budgets. All budgets will have an impact on cash budget, except the production budget. Production budget is just the number of units. Sales budget, of course, sales value will have an impact on cash, and it have an impact on debtors. So likewise, there is a relationship among different budgets. So by using these slides is really to use the that relationship. Okay, we'll come back to the next one. Steps in preparing an operating budgets. Prepare the sales budget, revenue budget. The sales budget shows the expected sales for a specific period, typically expressed in both rupees and units. Factors influence the sales forecast, include the sales volume in recent periods, general economic and industry condition, market research studies, pricing policies, advertising, sales promotion, competition, regulatory prices. So here, the factors influencing sales forecast means factors influencing demand. You have to consider, I think you can remember the demand theory. There, of course, when you look at the demand theory, we assume only the relevant price is changing. All other factors are constant. So thereby you can list any factor for sales. Maybe, your organizational factors, product quality, customer perception, customer value, tax matters, pricing, regulatory rules, economic matters, cultural environment, social environment, political environment. All these factors are really have an impact on sales figure. But therefore, forecasting sales, forecasting demand is not an easy task for your organization. It's a challenging. It's everything, whole process, whole operation of your organization depends on sales forecast. So thereby you should have a good statistics about your sales forecast. Even you may use customer service, market research, etc. If you look at recently, Mr. Dudley Sirisena, the big businessman, one of the big businessmen in rice industry, he is really forecasting the fertilizer requirement to cultivate paddy. He just forecasts. So thereby, so that is a kind of rational forecast based on the business knowledge. You should have the business knowledge. I think if you look at that video, so he is really forecasting the sales of, again, a fertilizer requirement of the country. Right. Better you watch that video. Then we have to prepare the sales budget. What I will do is I will not do this 8.3. I will prepare the sales budget later on. Shall we just complete today all the budgets? Then we will move on to the, calculations. 8.3 is preparing a budget. I hope that you all know which document it's if you look at your manual, page number 144, you have the what do you call this question? I have it. I can share it with you. Where is that? Yeah. I hope that you can see this. 8.3 activity is that as per your manual. What we will do is we will focus on this particular question. What you have to do is next week when you come to the class, please have this question. We will continue of preparing all budgets. Is it clear? You have to have this particular data to really continue the class. So thereby I'm just I will skip this 8.3, and next one is of course the production budget. Okay, there is one more question to be discussed. How do you forecast the demand for a supermarket? What are the limitations that you will face in deciding the forecast? Can you think? How do you forecast the demand for a supermarket? So you don't have a demand for a supermarket, but we are just talking about items, sales figure in the supermarket. When you run a supermarket, first of all, you should know that how many items you have in your supermarket. 1,000 or 1,200 or 2,000, 5,000. Each item you need forecast. Yogurt, whatever even one item may have different sizes, 1 kg, 500 grams, 200 grams, likewise. Anyhow, so I think, forecasting demand for item in a supermarket is not an easy task. So you should have the business knowledge and customer knowledge, and previous sales pattern may help you to really forecast the demand, but it's not easy. It's not easy. It's time consuming. You have to spend a lot of time on item. In certain cases, you may have sensitive item. Sensitive item means perishable item, for example, fish, like fish. So if there are perishable items, I think forecasting such items is sales demanding, forecasting demand for perishable items is much more important. So you need at least 99% accuracy. So thereby you forecast demand by using different techniques, different methods. And challenge is that limitation faced in designing the forecast. So the data is the limitation, and your experience maybe in certain cases. And since you have many number of items, how to, are there any particular software? Are there any particular Excel sheet or for us to, use? Because you can't just predict the sales like you are predicting your bakery. Bakery may have 5-10 items. So very easy to remember, but in a supermarket, not like complexities there. So thereby you need to be very careful. So thereby, rather than preparing, annual budget for a supermarket, what is much, you can have the annual budget even, but you need to prepare a very shorter period budget for supermarket, because it's always, changing, fluctuations, changes taken place. So thereby that's very important. Right, then prepare the budget, production budget in units. Always, even though sales budget is in rupees and units, Even though sales budget is rupees and units, the production budget is only in number of units. That's the specific unique feature of the production budgets. So you can prepare the production budget based on the sales. But when you prepare the production budget, what is required is to adjust finished good stock, no? Finished good stock. Stocks or the inventory, finished good inventory is required to adjust. For example, you need to deduct the opening finished goods and add back the closing finished goods when you prepare the production budget. Okay, then we will skip that activity. Then prepare the direct material usage budget. Now suppose, for example, I am just using few data for you to make it simple. Suppose your sales budget is 100 breads, 100 breads, or 100 yogurts, whatever, 100 breads. Then you have to prepare the, maybe for 1 month or 1 week, whatever, don't worry about the period, you need to produce 100 breads. Then what is the production budget? Production budget would be 100 breads minus opening stock. Maybe you may have 20 items, and plus the closing stocks, that is maybe another 5. So thereby, even though your sales budget is 100 units, 100 breads, you need to produce 85. That is depends on your stock. Day beginning stock, day end stock. So 85 production. But I know that bread, you can't, it's a perishable item, you can't keep it more than 1 day. Anyway, what I want to communicate to you is that when you prepare the production budget, so you just identify the sales and minus the closing stock and minus the opening stock and add back the closing stock. So thereby, when you prepare the what do you call this particular budget, what is important is the finished goods policy. How you are keeping, whether you are keeping stock or not. If you are keeping zero stock, then your production sales the same. If you have the stocks, no stock, just in time production, sales so much, production so much. Sales so much, production so much. So thereby, basically, if you are a perishable item businessman, I think this would be the model. Anyway, if not, if you are in a manufacturing setup, I think finished good policy, finished goods opening and closing, important for the production budget. Are you clear? Right. Then we will come back to the another budget, which is preparation of direct material budget and direct material purchases budget. Direct material usage, another name is we call it requirement. You can say requirement. Yes, requirement budget, requirements budget. One budget, direct material purchase. So direct material usage is depends on direct material usage budget is depends on the production budget. Purpose of brand material usage budget is to identify the required unit of each material to produce the required production. Suppose your production is I got 85 units. Huh? If the production is 85 units, if you need 2 items, 2 kg or whatever to produce 1 unit, of course, you need බින්දුවයි නේද? 100 units kg. Suppose this is units, the production, and you need to produce 1 units 2 kg. So you need 170 kgs. That is the production requirement, production schedule. If you use the ERP system, if you refer to the production schedule, you may get this direct material requirements from different items. For simplification, we use only one material. You may have 2-3 materials to produce 1 unit. So thereby, then you get the material labor requirement budget, or material 1 usage budget, material 2, material 3. Likewise, you may have different material usage budgets. Then the material purchase budget, of course, has to be prepared for the purchasing department, purchasing unit. Purpose of preparing direct material purchase budget is to determine the required number of units of each material to purchasing during a given period. So this is a given period, but you can prepare it in rupee wise also. Now you need 100 kg, 70 kg, right? And you again minus the opening raw material. Opening raw material, or say opening raw material is 220 kg, and you have to add back the closing material, maybe 30. Then your production, material purchase budget would be 180 kgs. You have to buy 180 kg in this period. So if one material, 1 kg is say 10 rupees, of course your material purchase budget in rupees would be 188. That is in rupees. So you can prepare the material budget as well. But again, when you prepare the material purchase budget, what is important is the raw material stock policy. Whether you have raw material stock or not. If you have zero stock material, if you don't stock any material, then stock adjustment is not there. It is material usage is equal to the material purchase. Why we prepare these two budget, material usage and material purchase budget? Because we always tend to keep inventory to make production smooth, we keep stocks to make this production process smooth. So thereby always you need to adjust, but you can prepare the purchase budget if the data given in rupees as well. I hope that you got this particular one. And remember, then if you look at this particular sales budget, I think you can remember the sales budget. Here 100 units, right? Now, suppose 1 unit is selling at 20 rupees, then your sales budget would be 2,000. So that is the sales budget in rupees. When you think about this sales budget, it has an impact on cash flow or the cash budget. It has an impact on cash flow, but factors to be considered is that credit policy, and cash sales. So thereby, when you prepare this particular sales budget, you have to remember it has an impact on your cash receipts. So when you calculate the impact of sales budget on cash budget, what you have to consider is two information: credit policy and cash sales. Out of these 2,000, how much cash sales? How much credit sales? If credit sales is so much, so what is the credit credit period. It is 30 days, 60 days, whatever. So thereby, when you prepare the cash flow, the cash budget, remember sales budget will have a link. Then we discuss the production budget. And it was 100 units, but nothing to do with the cash budget, production budget, because it's in units. Whatever the budgets in rupees will have an impact on cash budget. Then we prepare the material usage and direct material purchase budgets. Direct material usage is nothing to do with the cash budget, but direct material purchase budget will have an impact on cash budget or the cash flow. Now, according to our example, the purchases was 1,800. So thereby it has an impact on cash budget or the cash flow, cash outflow really itself, and also credit purchases, credit policy and cash purchases. Out of this 1,800, how much credit, how much cash? If all credit, then again we have to ask, what is the credit policy? Is it 60 days, 45 days, 15 days? Depending on that, it will have an impact on the cash budgets. Okay. Then 8.5, I will come back later. We will prepare it, not today, is tomorrow, day after tomorroo. Steps in preparing operating budgets. Direct manufacturing labor cost. Of course, labor cost you can prepare unit wise and rupee wise. Labor cost depends on the production budget. So thereby production budget will play a critical role. I think you can remember our production was 100 units. 100 units. Our production budget was 100 units. Suppose you need 3 labor hours or 8 labor hours, then labor hour requirement would be multiplied by 800 labor hours. If one labor hour is really 10 rupees, you multiplied it by 10, your labor cost would be 8,000. Okay, that is important. So 10, you labor budget you prepare based on budget, production budget. So you should know one unit, how many labor hours required, how many man hours required. Then based on that, you can do the labor budget, and you can convert the labor budget into rupees by multiplying the cost of the particular labor unit. Here in this case, I took 10 rupees per hour, so thereby 8,000. Again, this will have an impact on cash flow or cash budget, cash flow, right? Again, it depends on the policy. Are you paying salary? For example, if you focus on monthly, are you paying salary in the same month or next month? If you are making it this month, there is no problem. You have to pay this much. But if you are paying salary 1 month, say next month, then this 8,000 is not coming into this month budget. This 8,000 is coming into the next month budget. So thereby, again, cash flow, policy of payment is important when you are preparing the cash budget, when you are bringing the labor cost to the cash budget. So I think it's okay. Then prepare the manufacturing overhead cost. Of course, it's in manufacturing overheads, it has to be absorbed. So thereby allocation method is important. You need to understand how you are going to allocate production overheads among different product, different items, etc. So thereby, suppose this is absorbed based on labor hour. I think you can remember we need 800 labor hours. These are hours, labor hours to really produce the budget. Then 800 labor hours. We ask what is the production absorption rates. It may say that, okay, 2 rupees, then multiply it by 2 rupees. You will end up with 1,600 production overheads. So that is the budget. Again, the policy of payment, whether are you making the say for production budget. You may have the production overheads under different category, maybe depreciation, maybe, you know, machine operating cost, supervisory cost. Likewise, you know, manufacturing overheads may have different elements, but remember, whatever the elements, if depreciation is included here, it has no effect on cash flow. You have to remove that particular depreciation out of this total overheads. Okay. Then we will prepare the next budgets, other operating non-manufacturing cost budgets. Very simple. According to the given information, you can tell how much. So you may have distribution cost, variable non-manufacturing cost, you know, salaries, supervisory cost, distribution cost, admin cost, etc. Again, non-manufacturing cost budget will have an impact on cash budget, cash flow. So again, policy is required when you are making the payment. In addition to that, you may have tax payment, dividend payments, depending on the timing, we can put into the cash budget. Then the prepare a cash budget. I told you the logic of cash budgets. So then the we need to think about the master budget. Master budget is preparing, you know, income statement and the PA and the what do you call your balance sheet. So thereby, income statement you will get sales, but accrual, not the cash flow method, accrual method. You know that. Then you get the cost of sales, right? Then you get the GP, gross profit, then expenses. That is the normal, you know, income statement. You may have different categories. Sometimes you may have other income, other profit, other income also. Gross profit, you add back the other income. In expenses, maybe admin expenses, distribution expenses, depreciation, all these. Cost of sales. You know how to calculate the cost of sales? How to calculate the cost of sales? In manufacturing setup, how to calculate the cost of sales? You take the opening raw material, then you add back at the purchases, raw material purchases, then you minus the closing raw material, right? Then what you do? Then you add the direct labor, then you add of course production overheads. So this will be your manufacturing cost. Okay, the manufacturing cost. So in this, if you are manufacturing, if you prepare the raw material budget, material usage, etc., then of course opening raw material purchase, closing raw material. This is material consumed. You get the material consumed. So material consumed plus direct labor and production overhead, you get the manufacturing cost. For the manufacturing cost, you deduct opening finished goods, and you add back. Sorry, you add no. I think I did a small mistake. Yeah, that's correct. Opening raw material, added raw material, closing raw material minus. Okay, then the manufacturing cost plus the opening raw material, opening finished goods minus closing finished goods. That is your cost of sales. Then you can compare it with the sales, you can got profit, etc. So those are the things I think you can familiar with these calculations. Okay, then what I will do is, since we have other session, what we do is we will just talk about flexible budget is there. We can prepare the flexible budget, but before that, what I will do is I will explain the question which we had. So we will do this question to prepare the functional budget and the master budgets. Just for your information, 31st 2000 December data is given. The balance sheet is given. You see in the balance sheet, you have the stated capital, creditors, suppliers are given November and December. Tax payable, dividend payable, non-current assets, stock, raw material opening, kg, 4,000 kg, 300 value. In 1000, of course, 4,000 units and 1,800. So altogether, debtors are given. So this information, this is opening stock of raw material. This is closing stock, closing finished goods. And these are the debt amounts to be payable next period for the creditors, suppliers. These are the receivable from our customers for the next period. And this is the opening cash balance. And sales forecast is given. Of course, we need to prepare only January, March, April. January, February, March, 3 months budget we will prepare, not the others. We prepare only for these 3 months. January, February, March. Not today, tomorrow. The company forecast sales for the first half of the 2020 are as follows. Sales figures are given. So thereby sales budget is straightforward. Your sales budget would be the January sales, March sales, February and the March. And 20% month sales will be cash and the rest of the 80% would be credit. Out of this 2000, 20% is on, credit and 80%, 20% on cash and 80% on credit. And the price also differ. For the cash sales, 580, credit sales, 600. Then the material and labor requirements, since it's a manufacturing setup, direct material 2 kg is required to produce 1 unit. Direct labor hours 1.5 hours is required. 1 kg costing 75 rupees and 1 labor hour is 120. That information is important. Manufacturing overhead costs are absorbed to the product on the basis of the direct labor hours. The absorption rate is 80 per direct labor hour. Of course, this is to absorb the production overheads. Non-manufacturing overheads are given. There is a variable expense. I think it may be the selling expense. All others are fixed per month. Then the stock policies are given. Raw material stocks equal to the next month production requirement. Raw material you keep. Whatever the raw material in the stock, you keep next month production. Finished goods, of course, 2 months sales. So those two are important when preparing, material usage and the production budget. Work in progress is not given in the question, so thereby it will not have an impact on manufacturing cost. Purchases and selling, payment for raw material to be made average 2 months after delivery. Credit period is given. 2-month credit period is given to the suppliers, 60 days. Debtors will pay 50% on the same month, 30% of the following month, and 20% on the second month after sale. So you see, debtors policy is little bit complex. Credit policy, you need to understand this when preparing this, especially the cash budget. Other payments, direct wages, you will pay incurred period. Manufacturing cost and depreciation, machinery 120,000. Of course, this is for the annual depreciation. We need to convert it to month. I think monthly depreciation would be then 10,000. Fixed overheads incurred equal amount and is paid in the month of income tax. 31st March estimated 40,000 paid in March. So thereby there's an impact on cash flow. And for the tax payable, which was in the balance sheet, also settled in January. All other manufacturing and non-manufacturing costs are paid during the same month. It is expected to sell trade investment 250,000 during this month, January. It is expected to pay the proposed dividend also. You are required sales budget for the first 3 months. So we will prepare the budget for the first 3 months. And you have to remember this 250,000, if you go back to balance sheet, you see the balance sheet investment is 200. Now this investment is selling when it is being sold. I think period is not given anyway. So we assume that it is during the month of January. You are selling this during the month of January. So thereby 250 is the income of investment, and profit would be 50 rupees, which is coming under the other income or the profit on sale of investment, something like that. That is in the master budget. So what I will do is, if you have any question, I will answer. Otherwise, so with this point, I will wind up the session, and you have to next week when you are coming for the next class, please read this question, have an idea. So we will prepare all the budgets, but I don't think it's time for me to prepare all the budgets. It will take little time. So thereby, please come after reading this particular. Okay, thank you.